What's up, guys? I'm Nobody Special, and we got another inflation read today. The Consumer Price Index came in. It rose 5.4% year over year. That's the highest inflation read since August of 2008. We're going to dive into those numbers and what it could mean for the economy, as well as talk about some of the other factors that are out there that could influence inflation in the months to come. You ready? Hit it. Thank you for joining me. I'm Jack Gamble. I'm Nobody Special. And today, we got another transitory inflation read. The CPI index came in. We're up 5.4% year over year. That is the highest jump in inflation since August of 2008, basically right before the great financial crisis. That also comes in at 0.9% month over month. Now, the market was expecting a 5% year over year gain and a 0.5% month-over-month gain. Right? So again, more inflation than the market was expecting. Just how transitory is this inflation? Now, if you strip out food and energy prices, because nobody needs food and energy, right? People don't need to eat. People don't need running water. People don't need transportation. Anyways, if you strip out food and energy, for some reason the Fed likes to do that, inflation came in at 4.5%. Now, that's the highest read since September of 1991. All right. Now, we were expecting a 3.8% increase sans food and energy, and we got 4.5. So across the board, by any measure, inflation is higher than the market is expecting. Now, with a higher inflation read, typically we see higher interest rates. We should see the bond market starting to react because people demand more interest for their money when inflation is eating away at the spending power of any loans that they make in the bond market. But really, the bond market hasn't moved today. I mean, it's bounced around up or down a couple of basis points, but we saw very little movement. So that means real yields, or the yields on the bonds minus inflation, are now further into negative territory. So that gives us even more buoyancy on the price of precious metals, gold and silver, which miraculously have not really reacted to this higher inflation read. Now, as with previous months, by far the biggest contributing factor to this high inflation read has been used car prices. Due to the chip shortage, there's a shortage of new cars, which means all of that buying is forced into the used car market, and we're seeing reflection in the price of used cars. Now, that should be temporary or transitory unless you factor in what is causing that chip shortage. Now, there's a lot of reasons that are being listed for the chip shortage, but I can tell you a few of them are a lack of available workers and manpower, and the bottleneck at U.S. ports, and a lack of truck drivers and a breakdown in the logistics sector. Now, maybe this chip shortage really is temporary, but all of those things, the bottleneck at ports, the shortage of truck drivers, the shortage of workers, those are all caused by inflation. People don't want to go back to work because their wages are going down, relatively speaking. And we saw that in the BLS report today, the Bureau of Labor Statistics. Wages only increased by 0.3%, while inflation increased by 0.9%. So that means the spending power of the average paycheck went down by 0.5% last month. That's not how you get people to go back to work. If you want people to go to work, you have to pay them more. Well, if we pay them more, prices rise even more because employers have to pass those costs on to somebody, and that ends up being the consumer. So if we raise wages to solve these worker shortages, we're only going to make our inflation problem worse, which is only going to lead to more shortages. So you can see where we're really in a tough spot here. And we see a lot of headlines around the worker shortage and the truck driver shortage and the bottleneck at U.S. ports and the breakdown in the supply chain and truck drivers not coming to work. These are all related to inflation. And these problems are not going away anytime soon. Maybe one or two of these little problems will go away, but we're going to see other problems popping up in their place. Inflation causes this whack-a-mole gyration in the system, and this is all the result of all of this money that has been dumped into our system. That problem is not going away anytime soon. Now, the Federal Reserve has a dual mandate. They have two missions at the Federal Reserve. Number one is price stability. Try not to laugh, but that is the Fed's first mandate. Price stability, or to control inflation. Really doing a bang-up job over there, aren't they? Well, there's a reason why they're doing so poorly at price stabilization right now, because their other mandate is to maximize employment. That is their dual mandate, stable prices and maximum employment. Well, what we're seeing right now is this balancing act where the Fed is really being forced to pick between their two mandates, because if they try to improve one, they're going to weaken the other, right? If we want maximum employment, then employers are going to have to raise their wages. They just have to, because the cost of living is going up, and we're seeing it in the data. People are not being convinced to come back to work. Now, the expanded unemployment benefits expiring in September should alleviate that, but not entirely, I don't think. So it is inevitable. We have to see wages go up. Well, if wages go up, that pricing pressure gets passed on to the consumer, and that affects price stability. Well, if the Federal Reserve instead focuses more on price stability, if they decide they're going to stop quantitative easing and stop printing money to get prices to stabilize, that'll work, right? If they stop printing money, or if they start quantitative tightening, we will see prices stabilize, but that's going to cause prices of debt to go up, and that's going to cause companies to go out of business. That's going to hurt employment. So again, we're back into this damned if you do, damned if you don't scenario. The Fed is diametrically opposed to itself right now. It's being pulled in two opposite directions by its dual mandate. Now, while all of this is going on, there's a dark horse in this race, and that is the availability of credit. You see, when loans are made, either in the form of mortgages or car loans or personal lines of credit or credit cards, when debt is taken out, money is created. All right. The more credit, the more loans that are being issued, the more the money supply is expanding, and money supply is a direct input to inflation. Now, we had a story came out last week where Wells Fargo announced that they are terminating, effective immediately, all personal lines of credit. They're cutting it off. Now, that's a big deal, because when Wells Fargo announced that they're cutting off those lines of credit, that is money that is no longer in the system, right? If you were one of the Wells Fargo customers, which I can't imagine why anyone would be a Wells Fargo customer right now, but let's say hypothetically you're a Wells Fargo customer, you could access that personal line of credit and you could go buy a vehicle. You could use it to pay these higher prices for vehicles, or you could use that personal line of credit to pay for the higher food prices at the grocery store, or to pay your higher electric bill. That's money being created. Well, now that line of credit is not available to you. So the supply of money has been reduced by this Wells Fargo decision. Now, one bank alone doing this does not a trend make. And Wells Fargo is in kind of a unique situation, because they're still dealing with the fallout of their fake account scandal from a few years ago. Wells Fargo has a lot of regulatory limits placed on it, what it can do with its balance sheet. And it's very possible that Wells Fargo just thinks that they can take that balance sheet space and apply it in a different financial product and make more money. But there's also the case that Wells Fargo may be the first in a long line of financial institutions that are going to start tightening credit. That they're starting to realize, number one, maybe instead of making these low interest loans to people that there's counterparty risk when you make a loan, maybe they could just park it in the Fed's reverse repo facility where there is zero risk, collect that 5 basis points of interest that they're paying, and just do that. So that's one possibility. So keep an eye on credit markets. If we start to see more and more financial institutions start to crack down on lending and start to reduce lines of credit, then that could be a deflationary pressure in the market. And we are starting to see a lot of these other financial channels are starting to use the D word, the deflation word. And if we get a spike in interest rates, or if there's some kind of crisis in the credit markets, and we see a big sell-off in stocks, we could see deflation start to creep into the mainstream. Now, right now, as it stands, at least in the short term, for the next few months, the story is going to be inflation, at least until September. And I talked about that a couple of videos ago, talking about how the Treasury General account is being spent down and the government right now isn't borrowing more money. They're spending what they borrowed last year. Well, that all comes to a head in September when the Fed has to start borrowing again. So at least for the next month and a half, 2 months, this inflation story is going to stay in the headlines. But watch what's going on in those credit markets. There could be a deflation story in the making right now. I'm not saying that definitely is the case, but we're starting to see some of that creeping up. Anyways, guys, I really appreciate your time. If you like this video, please give me a thumbs up. Subscribe to my channel. It would really help me out. And in the meantime, live small and dream big.